Welcome to a fresh episode of Legal Wrangle on direct taxation. For this, we have selected 4 important cases. Let's begin with the first case. Noted senior tax lawyer Mr. Harish Salve is the assessee in this case. The assessing officer levied penalty on Mr. Salve for wrongly claiming depreciation on Bentley car and quoting wrong expenses under the head of loss on fixed assets, and the penalty was confirmed by the CITA. Let's see what the tribunal finally decided.
The tribunal observed that when Mr. Salve has foregone the benefit of 50% depreciation added back on account of Bentley car and offered the amount of tax to avoid litigation, he was asked to establish that he was using the car for professional purpose since the day of its acquisition. Since there was no documentary evidence to support the fact that he owned the car since the day of its purchase, as part payment for the same was completed later on due to customs requirement, he advised his accountant not to pursue the matter any further. The tribunal further observed that the claim for depreciation only gets deferred to subsequent year by claiming it for half year, and this deferral of depreciation allowance does not result in any concealment, furnishing of inaccurate particulars. However, it was a sheer accounting error in debiting loss incurred on sale of a fixed asset PL account instead of reducing the sale consideration from WDV of block under block concept of depreciation.
The tribunal further observed that an amount of approximately 1.5 lakh indicated as loss on fixed assets was omitted to be added back in the computation of income, and this error went unnoticed by even tax auditor. Hence, there was no intention to avoid payment of taxes. The quantum of tax payment on his returned income of about Rs 35 crore by Mr. Salve clearly indicates his intention to be the tax compliant. Let's now quickly understand what are the key takeaways. If assessee making an accounting error and then decides to forego depreciation benefits to avoid litigation, such deferral of allowance cannot be construed as concealment of income. When assessee pays tax to the tune of about Rs 11 crore, a minor error in the income reporting to the extent of Rs 14 lakhs cannot be said to be an attempt to evade tax. Now let's move on to our second case, where the door of apex court was pounded by an assessee who was denied deduction under section 80IA on the ground that such deduction was claimed without reducing depreciation allowance from it. The assessee is a manufacturer of master batches and compounds. While declaring its income, the assessee had included profits and gains derived from business of 2 of its eligible undertakings, however, purposely failed to reduce depreciation allowance from the total income. Although the Commissioner of Income Tax accepted this action, stating that the claim for depreciation was optional, the Division Bench of High Court clarified that even if assessee had an option to disclaim current depreciation while computing business income, the depreciation had to be reduced for computing profits eligible for deduction under section 80IA.
Here's the verdict of the apex court. Chapter 4, which allows depreciation under section 32, is linked to investment. Section 80IA not only contains substantive but procedural provisions for computation of special deduction. Thus, any device adopted to reduce or inflate the profit of eligible business has to be rejected. Allowing 100% deduction without taking into consideration depreciation which assessee wants to utilize in subsequent year would be anathema to the scheme under section 80IA, which is linked to profits.
Let's move on to our third case, where assessee was denied condonation for delay in the filing of appeal by ignoring the principle of natural justice, and that too simply for the reason that the delay was more than 8 years old. The assessee is a retired employee of a German bank who has been claiming deduction under section 80O with respect to salary earned by him from the employer. This claim was however disallowed and the matter was put to rest, as he refrained from pursuing litigation on advice of his chartered accountants, since the issue involved is identical to the previous one which was pending consideration before ITAT. As soon as the assessee came to know that the previous year assessment was restored to file of an assessing officer for deciding allowability of section 80O afresh, the assessee moved a rectification application before the assessing officer for accordingly deciding such matter in the present year too. This application was however rejected on the ground of huge delayed approach. The assessee pleaded before the tribunal stating that there was no negligence on his part, as delay of 8 years in filing appeal was attributed to his CAs, but in vain.
Here's the verdict of division bench. When delay of over 8 years in filing appeal was attributable to wrong professional advice, it can be said that reasons were beyond the assessee's control and hence the condemnation is possible. No litigant can be deprived of adjudication on merits if the court of law or the tribunal finds that the litigant has neither intentionally delayed filings of appeal nor his conduct was lacking in bona fides.
In our last case, a special bench was formed to decide the scope of revised return in amplifying the mistakes committed in original return. During assessment, the assessing officer had pointed out that though assessee company had shown payment of self-assessment tax, the same was not reflected in the income tax department software. The assessee accepted such defeat and filed revised return declaring admitted self-assessment tax liability. On these facts, the assessing officer imposed penalty for non-payment of self-assessment tax liability under section 140A. The assessee then approached division bench of tribunal relying upon the decision of ACIT versus Sri Shakti Credits Limited, where it was held that provisions of section 140A could only be invoked where assessee had not paid admitted tax liability while filing return under section 139. Since division bench had reservations on correctness of this approach, they recommended constitution of special bench.
Now let's see what special bench had decided. The special bench proposed that just because revised return substitute original return for purpose of adjudication on claims made in income tax return, this does not mean that revised return also substitute original income tax return for all legal purposes, including penal consequences for defaults. No assessee shall cease to be liable to any penalty under section 221 merely by reason of the fact that he had paid the tax before the levy of penalty. The special bench thus clarified that subsequent payment of tax, whether with or without revision of income tax return, is of no help to assessee so far as penal consequences under section 221 are concerned. A revised return would not substitute original income tax return for all legal purposes, including penal consequences in respect of defaults committed while filing original income tax return. Payment of admitted tax liability at the time of filing revised return would not obligate the lapse committed in non-payment of such liability at the time of filing original return, and hence consequences of earlier lapse will be visited with penal consequences. One-liner verdict is payment of admitted tax liability under section 140A through revised return will not obligate default committed in original return, and hence penal consequences will follow under section 221.
With this, we wrap up this episode of Legal Wrangle. Next time, we'll bring you some interesting cases from the world of excise and customs. Keep watching TIOL Tube for our upcoming education video series. You can also send us your feedback and suggestions at editor@tiol.in. Thank you for watching.